Hi everyone. We're going to start in about a few minutes. Or not a few minutes, a few seconds. We'll let everybody kind of log in that's waited, and we'll begin in a moment. Hi everyone. Thanks for joining us for today's webinar, Changes to FASB Reporting for Private Schools. For those of you looking for a copy of the presentation and a recording of today's webinar, I'll be sending that out within 48 hours of now. To get started though, we've got a few housekeeping items. I'd like to go through, you can maximize or minimize the webinar pane during the presentation by using the red, orange arrow buttons. During the webinar, we also encourage you to ask questions. You'll see at the bottom of that questions box in your webinar pane, just put the question in, click submit. As we go through the webinar, our presenters may have some time. If not, we'll definitely answer your questions at the end. Second, to ensure good audio quality, please check your settings. If you're using a telephone, please click on the phone call option. If you're listening through your computer, then please click on the computer audio option. Now, a quick review of the California and Texas CPE requirements. You must use a personal computer, no smartphones, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. There are 4, which means you need to answer 3, and you must complete the evaluation survey at the end of the webinar. Now a quick intro to our awesome presenters today. First up is Dean Quiyambo, partner with Armanino. He helps numerous private schools address their tax, audit, and outsourced accounting needs. Boards, finance, and audit committees have grasped his laser focus on bringing to life the audit items that matter most, including his proven method of benchmarking data and key financial operating ratios. Next up, we have Matt Gard, Senior Manager with our audit practice. He has more than 10 years of audit experience serving nonprofit and private school clients, including Harvard, Westlake, De La Salle, and a number of other schools across California. Jeff Owens, audit partner with Armanino, formerly with Travis Wolf, just joined us in January in Texas. We're glad to have him on board. He has more than 16 years of experience in public accounting. He focuses on serving the nonprofit and private education sectors, where he helps clients keep up with the accounting and tax regulatory environment, as well as maintain strong financial reporting processes and internal controls. Quick review of our learning objectives, again, for those of you here to join us for CPE. We're going to just talk about and identify the several proposed FASB reporting model changes, highlight how the new rules may affect your school's financial reporting procedures, and look at ways to effectively present the revised disclosures regarding net assets, endowments, and liquidity. A quick review of what we're going to talk about today, and I'll turn it over to Matt.
Yeah, so I think most are aware, probably everyone who's joined us today, that the FASB passed ASU 2016-14 this past year, and what that does is it really revamps the not-for-profit reporting model. It won't be effective for most of the private schools who have a June 30th year end until June 30th, 2019. So we have a couple years here before it's effective, but what we want to go over is what the changes are. And you'll see on your screen that the main topics and main items that are changed as a result of the new FASB are listed here. So we'll talk about what is changing and what can schools start to do over these next 2 years to get ready for this. We don't necessarily recommend that you start early adopting anything in this provision, but there's certain items that you may start to look at or that may need some change as you ramp up to prepare over this next 2-year period.
And Matt, I just want to circle back on a key item there. You said that you don't think any of our clients are going to early adopt any of this.
We're not recommending that they do so. There's a lot that goes into this. I think over the next 2 years you want to start looking at what you might need to change from a a chart of accounts perspective, what you might need to start change from tracking perspective,
sure.
and that's what you should focus on over these 2 years before it's fully effective. But I will say, if you are going to do comparative financials, and I know most of the schools do comparative financials, if you're in that year of 2019 when this is effective, if you're presenting 2018 data, a lot of these provisions will have to be adjusted as well for 2018. So we're really not looking at much time at all here.
Great, great. Good to know.
So with that, everybody, welcome to the webinar. Thanks, Matt, for the overview and Debbie for the introductions. I appreciate everybody spending their time with us today. I think this is exciting. I don't think there's anything that's earth-shattering per se, but certainly there's some pretty wide-sweeping changes to these financial reporting standards. So as Matt and Dean alluded to earlier, don't worry. There's quite a bit of time before these new standards become effective, and we'll talk more about that later. But I want to spend some time jumping into one of the more significant components of this new standard, and that's our net asset classifications. So I know that just when all of us got really comfortable with classifying net assets as unrestricted, temporarily restricted, or permanently restricted, the FASB again has thrown us a curveball. I think they like to do this to keep us on our toes. But this new standard really combines what we all know as temporarily and permanently restricted net assets into a single category now called net assets with donor restrictions. And additionally, all unrestricted net assets are now labeled as net assets without donor restrictions. So you'll see down in the blue shaded section below, there's a definition of what donor restriction or what a donor imposed restriction is, and it's not fundamentally different than what is currently under our existing standards, but there is a definition there for you. So moving on to the next slide, we are going to quickly show some implementation examples here, really of the statement of financial position, statement of activities, as well as the net asset footnote disclosures. We will show those net asset footnote disclosures later in the presentation, but for right now we're going to just focus on the financial position and statement of activities. So looking at this slide here, you can see that this is pretty similar to what you're used to seeing. I will draw your attention down below to the net asset section. You can see that there is a net assets without donor restrictions and with donor restrictions. So the without would be historically our unrestricted net assets, and then the with would be our temporarily and permanently restricted net assets. And we'll get into some more discussion later, but you are able to further break out the classifications here on the face of the financial statements, but we're going to recommend an approach where the further required information is included within the footnote disclosures. So moving on to the next slide, you can see here's our statement of activity presentation, and you'll notice there are now 2 columns, whereas in the past there were 3. So I do like this. I think it cleans up the statement of activities pretty nicely. It's just easier to use. But other than that, it's pretty straightforward. So once again, moving on to the next slide. So what are the action items or reminders needed to adopt this provision of the standard? So we will have to retrospectively apply this net asset presentation to the earliest period presented. So really start thinking about what complications, if any, may be created by adopting this new standard within your organization. It's important you start thinking through those now so you can get ahead of any conversations with board members or our various financial institutions. In addition, we are not recommending that you change your entire internal chart of accounts. I think that'd be very laborious and wouldn't necessarily provide any additional benefit to you. So what you would need to do is just map those internal chart of accounts to the new line items within your statement of financial position and activities. So certainly I don't think that's going to be too complex, but something you should be thinking about now. There is an item that I think could potentially be a pretty big change related to the standard. So any underwater restricted endowments are now going to be presented as a component of net assets with donor restrictions. And like I said, this is a significant change from current GAAP, as currently underwater endowments are presented as a reduction in unrestricted net assets. So if you do have this situation, which some of you might, this will likely lead to a prior period restatement within your current period financials. However, please rest assured this is just a reclass restatement. It will not impact the overall change in net assets or your net income for the organization. Additionally, investment changes on external donor restricted endowments are reported in assets with donor restrictions. It's not any real change here from current guidance. Board designated endowments and the related earnings are now reported as part of assets without restrictions, and again, there's not any significant change there. The real change as it relates to this will be within the disclosures. The disclosures are now much more significant than under the old standard, and again, we'll get into that in a bit later. So moving on to the next slide. So when do we need to start messing around with these new standards? So we did mention at the top of the call, I think Matt mentioned that these will be effective for schools for the years ending June 30, 2019. Early adoption is permitted. However, if you do choose to early adopt, you have to adopt the full standard. You can't just take bits and pieces of it. And we're not recommending early adoption at this point. We are a ways out from the effective date, and in my personal experience, these things can change slightly before the effective date, and there will likely be some more thorough implementation guidance that comes out between now and 2019. So I would say hang tight unless you have a burning desire to jump into the new standard. You certainly have some time to hang out. Now, if you do want to early adopt and you kind of want to geek out in the new standard, give me a call. I'll be happy to geek out with you, and we can talk through it. But if we move on to the next slide, just as some overall recommendations here, I know we've said it a couple times, but we want to keep the financial statement simple. Again, the recommended approach here is to just show the two required net asset classes on the face of the financial statements, and then break these out into more detail in the footnotes.
And Jeff, just to reiterate that, basically, it's going to take effect, and Matt as well, June 30, 2019, but if we show comparative statements, then June 30, 2018, if we have any underwater endowment component, then that's going to have to get reflected as well back into the what's our new classification called?
With and without donor restrictions.
Yeah, so it'll have to go to that bucket. Okay.
Exactly.
Good. So
yeah, just need to make sure
that. Okay.
Yeah, exactly. Track it now. Make sure you've got all the supporting documentation to support the June 30, 2018 financial position date. So with that, I guess we have polling question number 1.
Great. Thanks, Jeff. Polling question 1, again, if you're here for CPE, you'll need to answer 3 of the 4, so make sure you get this in. Do you like the disaggregation, I can't even talk this morning, goodness, of the net assets on the statement of financial position? A, yes, B, no, C, indifferent. Ugh, my life. Again, get those answers in. And for those of you wanting a copy of the slide deck, again, I'll be sending that out within a couple days of the webinar.
And these answers are important for CPE purposes, so we'll give everyone a chance to go ahead and click away here.
Exactly.
Yeah, and again, really what this question's getting at is, do you want it just presented as with and without donor restrictions, or do you want to break out board designations and various different assets or net asset classifications in there? So it looks like most of the people do like the disaggregation, and most people are indifferent. It's interesting.
Okay, so moving on, the next aspect that we're going to be talking about is how does this standard impact functional expenses. So under current GAAP, only voluntary health and welfare organizations are required to present a full statement of functional expenses, and I'm not sure any of the schools I've worked with have presented a separate statement of functional expenses. Most of the schools I work with are either you're required to present your expenses by function, and most of my clients present by function on the statement of activities, and some also add some information about the nature of expenses in footnotes as well. So when I mean nature, I'm talking about in the school environment, salaries, facility costs, insurance, interest, etc. so that's nature versus function, which would be your program expenses and your supporting services, your G&A and your fundraising. So under the new standard, all not-for-profit organizations are required to present both by nature and function. And I think the important thing here as well is that you're required to do it in the same place. So when I mentioned I have clients that show by function on the statement of activities and by nature in the footnotes, that's under the new standard that would no longer be in compliance with this because they do have to be in the same place. So there are a number of different reporting options available to do so. We'll walk through some of them and kind of our preferred look at how we would present this. So statement of activities, our recommendation is to do a functional presentation. When Jeff was talking earlier, you'll hear in a number of our slides, we like to keep the face of the financials pretty clear, concise, free of a lot of clutter. So by just leaving the functional expenses on the statement of activities, you reduce the amount of different line items there. And then in the footnotes, that's where we can break out this requirement to show both natural and functional expense presentation.
So yeah, what I'm hearing right there is just really keep it simple, right?
Absolutely.
Mm-hmm. For sure.
So moving on to the next slide, here's an example of the statement of activities. So basically what Jeff just showed, but I just wanted to show on the expense side, you'll see just program expenses, G&A, and fundraising. So very simple here on the statement of activities. And if we look at the next slide, here's what we're proposing, what a footnote, an example footnote would look like to meet this requirement where we have our program in supporting activities along the top, and then the natural class of expenses running downwards. So like I said, you have your salaries. This one breaks out supplies and travel, service and professional fees. So this is an example of a footnote that will meet the requirement while still letting the statement of activities be clear and concise and free from cluttered activity. So can you go back one more real quick? And then the last thing I want to comment on is at the bottom of this example there you see a little paragraph there, and this talks about how this particular school allocates their functional expenses. So as you know, your depreciation, your interest, your facility costs, which will be allocated between program and supporting activities. There is a requirement to list that you've done this, and a new requirement is that you actually indicate how you allocated them. In the past, a lot of footnotes I've seen is, we allocated on a reasonable methodology. Well, it doesn't give you a lot of information there. Here we say are allocated on a square footage basis, so that's your facilities, your depreciation costs. And then your salaries and benefits, which are allocated on the basis of estimates and time. So, the head of school who spends 50% in fundraising and then the other 50% between program and G&A, this is what that's talking about to allocate those costs. So a couple things to start considering to meet this requirement. Start looking at your chart of accounts to, if you're used to just presenting expenses by function, you are obviously going to have to show natural class as well. So if your chart of accounts isn't set up to handle this, you may want to start looking at it. Most schools that file 990s do already have to track this by both function and natural class, but if you're a school that is exempt from doing so, is maybe something that you want to look at. Again, make sure you have established an allocation approach for those indirect and shared expenses because they will have to be disclosed. And lastly, investment expenses. In the past, GAP hasn't had clear requirements as to where these should be presented. The new FASB says that the investment expenses will be net of investment return. So this will be up in your investment return on your statement of activities. As a result, it doesn't show up in your functional expense analysis because it will be up with net of investment return. So there was some diversity in practice in the past, but now it's clear of where this should be presented.
Thanks, Matt. Let me see if I can read this polling question up. So, which is your preferred method of functional and natural expense classification? Is it A, separate statement of functional and natural expenses, B, footnote disclosure only, no separate statement, or C, you're not sure? And as we go through, I know we're talking about a lot of material. If you've got any questions, again, a reminder to be able to enter those questions in the chat box on your webinar pane. We'll be able to get to those either during the webinar or toward the end. Give you a few seconds to get those answers in.
Get those in. CPE matters. We all know that.
And we'll close the polls in 3, 2, and 1. There we go.
That's about what we were expecting. That's good.
Yep, that's where I like to see it. That's my preference.
Okay, so moving on to implementation timeline. As we've mentioned, similar to everything else, fiscal years beginning after December 15, 2017 or June 30, 2019, if that's your year end. As Jeff had mentioned, most items are, if you're presenting comparatives, you do have to retrospectively adopt. This is one of the items that you do not have to retrospectively adopt if a comparative year is presented in the year of adoption. So so the footnote example we showed, which was 1 year, you don't have to show that for the previous period, 2018, because it's not required for this aspect of the new guidance. And just to wrap this up on functional expenses, so our recommended approach is the functional presentation on the statement of activities, the footnote showing both natural and functional classification. The last thing I wanted to mention here was the guidance doesn't give any indication on, when you're looking at natural classes of expenses on, should you present all those greater than 10% of total expenses? It gives you flexibility to present only, what you think matters most. So you should consider the users of your financials, boards, financial institutions. Obviously, salaries, facility costs, those will be some of the higher dollar ones, so you'll want to present those. But keep in mind any other individual line items, which may be a little bit smaller, but may be important to those users of the financials. This does give you flexibility to present what you think matters most.
And again, keep it simple. I know in our past webinars with other private school management and board members, we've always talked about the challenge of, quote unquote, keeping users of financials or board members out of your underwear drawer. And I think that that's kind of right there on that list line item. You don't want people digging into things that really just don't matter. So we really want to keep it simple here as well. I think the other point to bring up with regards to functional expenses is, again, the question we always get, Matt and Jeff, is, well, what should go where when we do this allocation methodology, right? And I think it's important to say that this doesn't add any more clarity to what should go where, right? You really want to go back down to what is accepted allocation methodologies for nonprofits and specifically private schools. You want to use a standard method of allocation, right, Matt?
Correct.
Okay, well, we have direct versus indirect cash flows popping up, and I was really surprised to see this concept of a direct cash flow statement really presenting itself within this ASU. And I don't know about you, Matt or Dean, but I don't see many of my clients present a direct statement of cash flows. It's just not something I typically see in practice. So I'm wondering if somebody at the FASB really wanted to keep direct cash flows alive and relevant. But
it's funny, Jeff. I don't think I've prepared a direct method since college, intermediate accounting 2.
Yeah, exactly. That's why I was so shocked that this really popped up. But I guess there's people out there that are still doing it. Some of you guys on the webinar may like doing that and maybe prefer doing that. So now this ASU gives you the option of doing that. I guess what's kind of nice is if you choose to present a direct statement of cash flows, you do not have to also disclose the reconciliation from direct to indirect in the footnotes. In the past, you used to have to do that, but I guess now they're stripping that requirement, which could be a good thing if you like direct cash flows. But moving on to the next slide, again, our recommendation would be to continue presenting an indirect statement of cash flows. It's easier to prepare. It's widely adopted. It's less costly to prepare, and it's just more likely than not that this approach will be the most widely accepted presentation practice going forward. So we recommend to keep doing that. However, if you do want to do it, you can. Moving on to the next slide, it is effective again for fiscal years ending June 30, 2019.
Hey Jeff,
so, Yeah.
Hey, real quick, we have a question coming in asking what is the difference between the direct and indirect cash flow statement?
Well, that's a great question. So indirect statement of cash flows starts with your net income and it works its way down to operating cash flows. And the other shows the direct sources and uses of cash flows from all of your operating activities. So it gets to the same answer, but it just takes a little different approach. The very nature of somebody asking that question, I think, implies that it's not really widely adopted. Nobody even really sees it today. So hopefully that answers your question. So moving on to the next slide brings us to polling question 3.
Yeah, I like it. So third question, again, for those of you here for CE, make sure you're paying attention and submit those answers. Which method of cash flow would your organization present? So actually Jeff's description just now hopefully helps you answer this. Is it A, direct, B, indirect, or C, not sure? And get those answers in. Want to make sure you get that CPE. And we'll close the polls in 3, 2, and 1.
Yeah, that's in line with kind of what I was expecting. And for those of you who do want to present direct, there's nothing wrong with it. It is a useful statement. It's just not one that we normally see. But I'm happy to see that people are actually still using it.
Okay, I'll touch on the next point, and this is the placed in service approach for reporting expirations of restrictions on on long-lived assets. And what we usually see here in the school world is, donors, when you're in a capital campaign and donors give money to build a building. And the question is, excuse me, is when do you place those restricted assets into service? Sorry, I have a cold and I can't speak right now.
Hold please. Jeff, take over. What are you doing?
Sorry about that. So what we should be using is the placed in service approach. So once the building is completed and placed into service, that is when those restricted assets would be released. There is currently in GAAP an option to release over the useful life of the asset. So you build the building, has a 40-year life. You have an option to release this by the same amount over those 40 years. I think in my career I've only seen this a couple of times, so it's not prevalent. The place and service approach is used by most of the organizations that I've seen, but it does eliminate that option. And the new guidance is very clear that that in a construction project, when the asset is placed into service, that is when you would release those donor restrictions. Where in the past, the former GAAP guidance was a little bit less clear on this concept.
Matt, I'm glad you brought that up. That seems to be a hot topic issue. We've brought that up at several presentations that we've done with or at the MBOA annual symposium. And it's always a question that we get, because I think logically, when you get, let's just say $1 million, or say you got $100,000, of cash collections for a building, and you incurred $100,000 of building expenses, I think historically people just release that as they go, right? As they've incurred the expense, as they've paid the bills, and as that asset is being called construction in progress, that release has occurred. And this is kind of clearly saying that the asset needs to be placed in service. So that clarification, I think, is good.
Yeah, okay. So action items, if you do have anything like this going on where there's time restrictions on long-lived assets, start looking at when you would release these. And if you are using the former option of releasing over the depreciation expense, you'll have to start looking at, when you do adopt this, of how that will impact, moving the entire amount into, without donor restrictions. So if you are using the former option, then there's a little bit you'll have to do to restate once you implement this. Again, this is consistent when this is effective as everything else, and with this one, it will have a retrospective approach to the earliest period presented.
So now we get into the moment everybody's been waiting for, right? I'm sure everybody's so excited to hear what we have to do to increase our disclosure requirements. So let's first jump into net assets without donor restrictions. So again, this is our unrestricted net asset disclosures. And under the current guidance, under current GAAP, there is no requirement to describe the amount and purpose of board designated net assets. However, under the proposed ASU, we are now required to disclose this information, again, either on the face of the financial statements or in the footnotes. And I know we've messaged this several times throughout this webinar, but we're recommending to keep the face of the financial statements relatively clean and disclose everything in the footnotes. Now, I recognize that many organizations are probably already doing this kind of as accepted practice. So this, I don't think, will have much impact to them. But if you're not currently presenting this information in this way, where you're disclosing the internal or board designated net assets, you will need to start gathering this information to compile these disclosures fairly soon. So again, with the adoption of the standard for June 30, 2019, with a comparative financial statement presentation, you will need this information for the year ended June 30, 18 as well. So keep that in mind. So moving on, if your school does have internal designations, you should ensure that any board resolutions are finalized and documented well if they're not already done. One item to note here is that boards can actually delegate authority to the organization's management team to determine and make these internal designations. You still would capture these within the footnotes or on the face of the financial statements as board designated net assets for financial reporting purposes. In addition, you would also need to disclose separate internal designations. These are kind of aside from board designated net assets for such items as capital projects, operating reserves, or for earmarked funds for future programs, or et cetera. So again, this is probably already being done by most organizations, but if not, you will need to start thinking about how to present this information. So moving on to the next page. So again, we've beaten this point to a pulp, and I apologize for keep bringing it up, but our recommendation is to keep those financial statements relatively clear and disclose everything in the footnotes. So on to the next slide. We just wanted to show a fairly straightforward example of how these board designated and the internal designation net assets would be disclosed in the footnote. So this is a very simplistic presentation, and we recognize that you may need more robust disclosures depending on your specific situation, but this is a very high-level view of what that would look like. And then moving on to the next slide, again, implementation timeline. We do need to make sure that all board resolutions or other documents are in order ASAP so that these required disclosures can be completed, and this should be in the works relatively soon. This also does have some links to our liquidity disclosures that Matt will talk about here in a little bit. But you can start doing this now if you'd like. Nothing precludes you in the current guidance from disclosing this information in your 17 or 18 financials. If you like to disaggregate this data and include it, you're more than welcome to. So let's move on to the next slide and talk about net assets with donor restrictions. And as you'll see, we've only got a few slides here. I don't think there's anything here that's really significant in terms of a change in this area. You see that we will still have to disclose the nature and purpose of any purpose or time restricted net assets, which is kind of what we're showing here. And then on this next slide, you'll see that we have a detailed disclosure here showing the release of those restrictions related to the purpose and the time restrictions. Again, there's no significant presentation changes here from what we've historically seen under the existing guidance.
Hey, Jeff, real quick.
Yeah.
If we go back a couple slides. Sorry, forward one more, I think. Anyway, the one that shows the net assets with donor restrictions, where this one right here. So this one, I just wanted to point out, in the past, you may have had, two separate disclosures for this. You may have had a footnote disclosure for temporarily restricted net assets and a separate one for permanently restricted net assets. So you see here, now that we have reduced those into net assets with donor restrictions, information that would have previously been in two footnotes is now combined into one, because you want that bottom line total net assets with donor restrictions to tie back to your statement of financial position. So both of these items will be combined into one disclosure, whereas in the past there have probably been two or maybe even more.
Great point. Absolutely.
Okay, I will talk about some of the changes in the endowment disclosures as a result of the new ASU. Overall, there's not much that's changing for how the endowments are presented, besides the terminology that we've already kind of discussed, and the underwater. Obviously, that's the big one, where in the past, the underwater endowments would run through without donor restrictions. Now they will run through with donor restrictions. In addition to that, most of the other changes related to endowment do relate to underwater endowments, and it's more disclosure, more transparency related to these underwater endowments. And I guess just to clarify, if those on the line may not be familiar with underwater endowment, but that's when the value of the endowment drops below the corpus gift. So if the gift is $1 million and due to investment performance, it's now $950,000. That's an underwater endowment. And much of the changes in this ASU are providing more disclosure and transparency in relation to underwater endowments.
And this was the one earlier, right, that we had talked about, where it now would be accounted for in the area with net assets with restriction.
Correct.
Okay.
And we'll see an example of this coming up. So like I mentioned, with underwater funds, if your school does have some underwater endowment funds, there'll be some additional disclosures regarding the board's ability to spend from underwater funds. If a fund's underwater and the school and the board has determined that they can still release from those funds even with underwater, we have to understand the interpretation of why you think it's prudent to do so. So some of that will have to be disclosed in the financials. Also, as we mentioned, this will be reported in those net assets with donor restrictions, and it could cause a prior period restatement when you go to implement this if you are presenting the 2018 items. So start to look at that now. You're similar to what's already required, your endowment spending policy, but again, includes specifics on if there are any appropriations from underwater endowments and what those amounts are. And the last thing here is investment return. In the past, you were required to, with your endowment, break it out between gains and losses versus investment income. Now you can just show one line item in your endowment roll forward, just investment return net. You don't have to break out between the two categories any longer. Some additional items with underwater endowment funds, you'll have to disclose the fair value of underwater funds, the original endowment gift that you're required to maintain by donor stipulations. So in my example, if the original gift is $1 million and now it's $950,000, all that types of information would be disclosed in your footnotes. So again, you have flexibility if you wanted to include some of this information on your core statements, but we recommend keeping everything in the footnotes to keep it clear and concise. So let's look at some example footnotes. So here's your standard endowment composition. In the past, we'd have the 3 columns showing unrestricted, temp, and perm. Now we have our 2 columns. See, all the board designated funds are without donor restrictions. The donor restricted endowment funds are with donor restrictions. This breaks out the amount of corpus, the amount of unappropriated endowment earnings. If there was underwater endowment, it would run through that column as well and be presented here as well.
And I just want to make sure I didn't misread the last slide, or maybe a slide a couple two back, but it said you need to disclose the amount of underwater endowment even for board designated. That's not correct. I read that wrong, right, Matt?
No, just for donor restricted.
Only for donor restricted. Okay, great.
Okay, and let's look at the next example. And then here's your, your endowment roll forward that you're used to presenting in your financials, and how it would look differently under the new terminology. So again, we have our two-column approach. This organization has board designated endowment, so that's what's flowing through the without donor restriction line item. Shows your investment return net as one line item. Like I said, that's all you're required to do is present that net with the new standard. Your contributions, so any new endowment contributions, obviously those are donor restricted, so it would run through the with donor restriction column. We list our appropriation, so there's appropriation from both the board designated endowment as well as the donor restricted endowment. And then lastly, board designations, so these are new designations that the board made during the year that would flow through that without donor restricted column.
Thanks, Matt. We do have a question, and it's from Tim, and he asked, does underwater board, restricted endowments have to be disclosed by detail, or are we just showing a number that says, hey, our corpus of our endowment is $1 million, and in total we're underwater 50,000, or does it need to be broken out by
it doesn't
various...
have to be detailed. It's in summary, because there's certain organizations where they could have hundreds of funds.
Mm-hmm.
And, it would not be feasible to break all those out.
Good.
Okay, so implementation timeline, immediate analysis of policy updates, especially if you do have an underwater endowment. Start talking about what our policy is in relation to this. Do we allow for appropriation from an underwater endowment? If we are going to allow for it, make sure you have a policy, because it will be ending up in the footnotes here when this becomes effective. If there's any considerations that you need to make to separate the donor versus board designated endowment assets, schools should already be doing this, so there's probably no change there. Again, if there's there could be a prior period adjustment, so start taking a look at that if you have underwater endowment. If the school doesn't and it's not in danger of doing so, a lot of these changes won't impact your school. And again, this is effective for most schools June 30th, 19, with retrospective application.
Oh, yes. One of the areas that has caused a lot of questions.
Yeah, so hopefully most of the changes we walked through haven't been too difficult, or you're looking at them as not being that time consuming. A lot of changes in terminology, reducing the number of columns, etc. This is the one that probably has the most changes. As you're probably aware, in current GAAP, there's nothing that requires an organization to make the specific disclosures in regards to their liquidity position, whereas the new standard is making that a requirement. So this is one of the biggest changes, as I mentioned, and I think what they're doing with this change is aiming to aid in transparency of liquidity for not-for-profits. So you're all aware, your board members, your finance committee members, many of them are for-profit people, and not-for-profit is different. And with the way not-for-profit reports, it can look like your liquidity position is way better in one year than it may be in actuality. And I think what this disclosure does is really give the user of the financial statements a true representation of their liquidity position. So, and I think for most schools, I mean, it allows the school to tell a story. If you are having liquidity challenges, this footnote allows you to tell, this is what we have, but these are our obligations, and we need some assistance. So it is, provides much more transparency and disclosure, but it can also be beneficial and really show the true story and position of the school.
Yeah, this is definitely like that MD&A kind of analysis that we're used to And, if you ever worked at a public company or maybe some of the government reporting, that analysis and discussion that people are used to.
So the new guidance talks about a couple different things. So you're required to present both qualitative information as well as quantitative information. So qualitative information to consider, if there's special borrowing arrangements for, as part of a debt agreement that a certain amount of cash has to be made in a specific account. Obviously, that's not liquid, so you would talk about that. If the organization does have known liquidity problems, you would have discussion of that. And if there's any other limitations from other contractual agreements, if the organization has used some donor restricted assets to fund current year operations because you are in a liquidity challenged position, that type of information would be qualitative info that you would need to present. As far as quantitative side, this is where, you would present some of the amounts as to what is the school's liquid position. You would also have to consider any external limits imposed by donors. So you may have contributions receivable of a certain amount, but if it's all, earmarked for a building, it can't be used in operations. So you'd have to consider that and disclose that in your financials. There's internal limits by the board. So you have a board designated endowment. It's limited right now. It can be reversed and moved out of board designated, but you would want to indicate that in your footnote that, we have $2 million of board designated endowment that currently cannot be used for our operations, but those restrictions could be, or those designations could be lifted by the board and then they could be used. So we're going to be looking at an example of how to incorporate all these different items here coming up. Let's skip this one as I think I talked about most of this. So a couple things to start considering before we look at an example is one area you may want to consider is presenting your statement of financial position in a classified manner, because this may help aid with this liquidity disclosure. And by classified manner, I mean that's when your statement of financial position is broken out between current assets and liabilities and non-current assets and liabilities. And we're suggesting this may be something you want to look at because it might more easily facilitate this liquidity disclosure, knowing exactly what your current assets are, what your current liabilities are, and it may more easily map into this footnote. Again, keep this kind of information in the footnotes rather than on the face of the financials. This is one of the ones that you do not have to present comparative information for in the year of adoption. So if you're adopting June 30 of 19, you don't have to discuss your liquidity position from 2018 in the comparative financial statement. And so if we skip on to the next slide, we'll start looking at an example of how this might look. I'm not going to read this for you word for word. It's definitely a lot going on here. And we are internally still putting together a standard footnote liquidity disclosure for our private school practice that we will be sharing with our clients and anyone else that needs assistance with this type of disclosure. But overall, I just wanted to walk through how this addresses some of the points I talked about on a previous slide. So the second line item here talks about, the school holds in short-term investments an amount equal to at least 3 months of operating expenses. So that's kind of its policy for managing its payables. It indicates that long-term investments include endowment funds, includes quasi-endowment funds. They're expecting to appropriate $500,000 from their quasi-endowment over the next 12 months, but the entire endowment could be made available in its entirety if needed. Then it talks about there are certain limitations on their long-term investments where they have certain lockup restrictions. So if you have investments that, maybe alternative and partnerships where, it's cannot easily liquidate, you would have to talk about those and how they're not immediately available for liquidation. So this one talks about, the school would be able to access these funds with a 60-day redemption notice at the end of any calendar year, but currently they're not available to support their general expenditure. So when I talked about, if there's any contractual or any other types of limitations, we need to discuss that in this footnote.
And I think that that's where you can be strategic, right? We do have time to implement this FASB, and I think one of the things that we got to look at is the investment policy at some of the schools, right? Some of the schools that we have, pretty exotic investments, and they're very large numbers, and a lot of them can be challenging with regards to how fast they could actually access those dollars, right? So I think you need to look at it and say, okay, well, how much do we want to keep in this investment? Or what is that saying about our liquidity, and how could that affect that? Is that fair to say, Matt?
Yeah, absolutely. Before moving on, I think we have a question related to this. It says, in defining liquidity, what is the maximum time frame allowed for access to funds? I don't know if, hopefully I answer this question or what you're looking for, but so you're really looking at a year time horizon and a 12-month, and what your liquidity position is to meet your operating needs over that next year's time horizon. Jeff or Dean, do you have anything to add on that?
Yeah, I was just going to chime in and say, really, you should be looking 12 months from the date those financial statements are really available to be issued, rather than 12 months from the balance sheet date or the statement of financial position date.
So there's a follow-up question to that. As an example, if you have reserve funds in a Vanguard account that can be accessed within a week, then that would be available to be used pretty liquid if it's available within a week.
Yeah, we're really concerned about the private equity, and not picking on them, but private equity level 3 type investments that can be kind of illiquid or take a while. We do have numerous clients that invest in funds that only allow for liquidation on a quarterly basis or things of that nature.
I think Dean and I were looking at a school recently that had 5 to 10 year lockup periods. So obviously those would have would definitely need to be disclosed in this type of footnote.
Right, and that's exactly what the FASB is trying to accomplish here, right? You're going to look at a school financial statement, and you're going to see all of that cash and receivables and investments, but you know what? Maybe that cash is already sitting there. Maybe that cash in AR is directly tied to deferred revenue. And then maybe that investment is directly tied to the endowment. And when you try to calculate, real liquidity for use, it shows a tighter number. And the school can use that for its advantage in a disclosure like this.
Great. And so just continuing with this example disclosure, this goes in to talk about some tuition and fee receivable that's, aged and collectability is in question. So the school does not consider those to be readily available to fund general expenditures. It talks about its contribution receivable position, and that, a large portion of it is they're in the midst of a capital campaign, and all those, dollars are spoken for. So when you go on to present the quantitative disclosure at the bottom, you would factor those types of items in, that, your contributions receivable, you're not going to show your entire amount. You're going to show basically your unrestricted amount, and those that are, going to be able to support general operations of the school. So again, here's the example of a quantitative disclosure showing, the cash that the school has, those contributions receivable that are, could be used for operations, those short-term investments that could be, readily available for operations. And then I think it mentioned previously that they're planning to appropriate, about $500,000 from their long-term endowment. And, that's what they can look at as being used for general operations as well. So this is just an example that includes, all those qualitative and quantitative disclosures that are now going to be required.
Thanks, Matt. And now we're on to our fourth and final polling question. For those of you here for CE, and in case you've missed one previously, make sure that you answer this one. Question is, do you believe the liquidity disclosure requirements will call for more scrutiny from external constituents? A, yes, we're going to have more scrutiny. B, no, less scrutiny. Or C, you're pretty indifferent. And for those of you asking, yes, I will be sending out the slide deck and a recording of the webinar within 48 hours. And now's a good time, as we get closer to the close of the presentation, to enter those questions you might have. We've got some time to answer those toward the end. Get those polling question answers in. And we'll close the polls here in 3, 2, and 1. Looks like 60% or so are saying more scrutiny, 40% are pretty indifferent, most people saying no less scrutiny, for sure.
Okay, real quick, I think we had another question that we wanted to address related to underwater endowments, and it says, how far back do we go? So again, if this is, if you're implementing in June 30th, 19 and you're showing 2018 information, you would really catch up all your underwater endowment and flow that through the 2018 amount so that when you have your comparative year over year, you're really showing an apples to apples comparative as to what the true underwater amount is and that it's in the right category for both years. Okay, so timeline again, and things you could start to consider. If you are interested in potentially presenting a classified statement of financial position, this is something you could start doing now. When I showed the quantitative disclosure, with the amounts of cash and short-term investments, if you wanted to be able to easily tie this back to your statement of financial position, a classified balance sheet would help with doing so. So if that's something you're interested in doing, that's something you can implement now or over the next year or two before this becomes fully effective. But again, everything else will be June 30th, 19 with that retrospective application back to the earliest year presented. And then for the comparative financials, just the option to present the liquidity in the year of adoption only. We have another question coming in just a second. It says, what happens with multi-year unrestricted gift? Is this part payable in the future considered with donor restrictions?
That sounds like that. That sounds like that implied time restriction right there, right? How is that going to get handled?
Yeah, that'd be correct. That would be with donor restriction, and you would need to present value that future contribution, and it would be reflected as with donor restrictions in your statement of financial position.
And then just in conclusion, before we have a few minutes to take any additional questions, how can we help? We're here. We can help you understand and implement the new FASB reporting requirements. We've definitely read through the standards. We've given similar presentations a number of times, so we're very familiar with the new standard and how this impacts the private school world. We did mention there may be a few changes where you may want to consider looking at charts of accounts or evaluating if your current system can manage these new changes that we've walked through. If it's something you want to look at as far as a new system, that's something we could potentially help with as well. And if you do use a system that we have some expertise in, we can help set this up for you and make it so that you're able to meet these new reporting requirements.
Matt, I think we found another pretty good question here. Does one need to disclose that much or how much of the unrestricted cash reported at June 30 is from tuition for the upcoming year? So essentially the cash that's coming from deferred.
Right, yeah. So I think it would make sense to disclose that. I think in the example we showed, it talked about how they had some tuition from previous years that they weren't going to include in the disclosure because the collectability was in question. Whereas I think in your question, you've collected all this cash for next year, and it's going to be used in the following year's operations. But like I said, we're looking at a 12 kind of month lookout as to how you're going to manage your liquidity horizon, and all that cash would be able to be used over that next 12 months.
So yeah, that makes sense. I guess the only thing then is if you had any cash that theoretically, if you had that family that maybe paid 4 years in advance or something like that, then you would want to piece that out.
Perfect. Thanks, gentlemen. A quick recap of our webinar today. During the webinar, we've identified the proposed FASB reporting model changes, highlighted how the new rules may affect specific schools' financial reporting procedures, and listed ways to effectively present and revise disclosures regarding net assets, endowments, and liquidity. We've got a few questions coming in. If we want to answer any of them right now, we can take one more.
Is there any more? Is there another one?
I don't know. We have a lot of questions popping up on the board. So I think what's important, we'll make sure we follow up to get all your questions answered. There's a lot coming in, so it's hard to keep up with.
Yeah, we'll definitely circle around and make sure we get all of these questions answered for everyone. Thank you so much for attending.
Perfect. Thank you. Everyone's contact info is up there. You'll receive the slides and the recording. And if you've missed anything, feel free to reply to my email I'll send out, get any additional questions in, and we'll make sure to follow up with you. Thanks so much for joining us, and look forward to seeing you at a future webinar.